Hi, welcome to the June webinar for Vinlink. My name's Paul Green. I'm a director of the forensic accounting and corporate advisory area of Vincents, and I'm joined today by my fellow director, Peter Haley. We're going to talk today about specifically to do with accounting practices and how to successfully sell or buy a practice without using a broker, and we'll also talk about, in the event that you do consider using a broker, the sorts of profiles of brokers that you might want to use and the things that you would demand from them. So the session outcomes today, we want to go through the key transaction steps, how to avoid the traps and maximise outcomes, predominantly from the vendor's perspective, but as you will see as we go through this, if we can maximise the outcome for the purchaser, ultimately that will result in a maximised outcome in terms of price for the vendor. We'll also talk about some current market commentary for practice sales and purchases. We've got this information from a number of sources, including our own valuation sources. We do a lot of valuation work for banks, also in discussions with banks and other accountants, including other Vinlink members. I think the most important consideration is, particularly for vendors, but also for purchasers, is to make sure you go into the process realising that it's more than just a transaction. So it's not a matter of deciding today that you're going to sell the practice or buy a practice and seek out a book of fees or put your book of fees on the market and hope to sell it within a couple of months. In doing so, a vendor is likely to undervalue the practice, certainly get underpaid for the practice, and a purchaser is likely to end up with a practice that's ill-fitting with their long-term goals.
And I think you've also got to be commercial, as you go through the process. You might have a price in mind, but as you start to negotiate out there, you've got to be realistic, and if everyone's offering you 20% less than what you think it's worth, well, maybe you need to have a reality check and just keep that in mind and not just think a particular price that you've got in mind.
Yeah, and I think also for the vendor, the transaction extends beyond the settlement date. Certainly we've been involved in a number of litigations where after the fact actions have been taken by the purchaser against the vendor for misleading or deceptive conduct, and it may not be that that's actually the case, but that the vendor really hasn't helped the purchaser in transitioning the clients, and has led to major disputes. And in order to avoid this, the vendor should consider that the transaction extends for a lengthy period beyond the settlement date.
And I think that's something, my own experience is that something to keep in mind, that mentally, you decide to sell and you just want to move on, but realistically you're probably looking at a 2 to 3 year time frame before you can totally move on. And there's obviously debtors of the old practice to collect and all those sort of issues as well, where it keeps dragging on. So it's not just like being an employee and walking out the door. You've got to mentally realise the process as well. It's not a happen one day and away you go sort of thing.
So to maximise a happy outcome, the vendor needs to be sale ready, and the purchaser needs to be genuinely ready to take on the acquisition, have a plan as to how this transition is going to occur and what the long-term plan is for this business, or if it's buying a book of fees, the merger of those fees with an existing business, how they're going to do it structurally, including employee numbers, etc., as well as financially. They just simply need to be organised. The actual transaction, the sale, ultimately looks after itself with the assistance of accountants if you're using an external advocate or your lawyers. I might get Pete to talk about what banks want. Peter does a lot of valuations for banks, particularly in professional services and accounting firms.
Thanks, Paul. Yeah, as Paul said, we do a fair bit of work of giving the bank a valuation to back up a lend they're making on a practice. You see on the slide there we talk about limited scope due diligence. To be honest, the banks don't request that very often, but the sort of things they do want in a valuation report, and I think we'll cover those in a bit more detail later on, the sort of things that the vendor should be providing, but that they specifically request that we provide in the valuation report are things such as staff productivity, our opinion on that compared to industry norms, and a lot of it is all compared to industry norms and our experience. So staff productivity, write-off percentages, where the fees come from, is it typical biz services, audit, fin planning, and other things such as the top 20 clients by dollar and percentage, and sort of a banding of clients they often sort of request as well.
A lot of those items that are requested by the bank would normally be requested by the purchaser in any event, so it should really be no surprise other than the fact that an external accountant such as ourselves is reviewing those for reasonableness against peers. I think the other thing that banks have asked us to comment on specifically is particularly in relation to financial advisory businesses that might be tacked on to the accounting practice and what they mean for value, and we've certainly taken a view, as have the banks, that those fees are generally so integrated with the accounting practice that it's inappropriate to value the financial planning fees separately and according to what many of you might understand to be financial planning multiples, being a multiple of recurring income. The banks generally reject that. In most cases we reject that, and the banks prefer to have those fees effectively incorporated into the overall fees and net profit of the collective practice and valued as a single operation.
Having said that, sometimes the multiple applied to the profitability of the fin planning practice is slightly higher than an accountancy practice though.
Okay, so for the purchaser, we generally think that the lead time should be as much as 1 year to as far out as 3 years, but 1 year is adequate to adequately prepare for the decision to buy a business. The post-settlement timeframes can be from 6 months to a couple of years, depending on the complexity of the practice and the requirements to have the vendor's continued involvement in the practice. The actual transaction process is normally about 4 months, but can drag out a lot longer than that. Now, when we're talking about a purchaser, in this instance, we're talking about a purchaser who's buying, who is new to the practice and is buying the practice lock, stock and barrel. So obviously a purchaser who's coming through who was an employee of the practice and is buying the practice over a number of years. A lot of that lead time disappears because a lot of the knowledge that would be required by a purchaser already rests in the employee. They understand the nature of the fees, the risks to retaining the fees in the event of the retirement of the existing practitioner, etc. So with the vendor process, I think the vendor process is far more onerous on the vendor, and mainly that's because, particularly in small practices, the level of accounting is relatively basic, whereas the information requirements of a purchaser is normally far more detailed. So the vendor process normally starts with a decision to sell. Now that decision to sell can vary from an outright sale to a third party, a sale to a corporate with all the complexities that involves, the merger of that practice with another practice, or the selling down over time to an employee or group of employees. In any event, there's a serious requirement to disclose and prior to that collate appropriate data for the purchaser to get a proper understanding of the business. In some ways we call that getting due diligence ready, so you need to have the answers to the questions that will ultimately be asked by a purchaser in buying the business. You'll need to prepare obviously an information memorandum, which is not a voluminous document but a document that provides a nice snapshot of the practice, its history, its strengths, its weaknesses, the opportunities that present themselves. The vendor will then need to ascertain their own mind appropriate pricing, and we of course recommend that be done at a reasonable level and not seeking to obtain a premium that quite simply isn't there, particularly in accounting practices where hopefully the purchaser is, being an accountant, is at least somewhat savvy as to rates of return and the profitability of the practice. In other words, normally the purchaser in this instance would be relatively educated in the ways of value. The next step then is to work out, is to establish some targets, who are potential purchasers, and then go about promoting to those potential targets, and they can take a range of options from newspaper advertisements to direct phone calls. Then you'll need to determine or appoint a negotiating party, so that might be an independent third party such as ourselves. You may decide to choose a broker. You may indeed appoint yourselves as the negotiating party, or the or a solicitor, for example. There's some risk in appointing yourself as a negotiating party, in that you mightn't get as clear feedback and expression of concerns directly to yourselves that you might get through a third party. Once we're underway, it's a matter then of managing inquiries. Obviously early on trying to avoid as many tire kickers as possible, low ball offers, those sorts of things. You then move, once you've narrowed your inquiries to genuine inquiries, to meetings and information exchange, the use of non-disclosure documents. So you want to be relatively serious there, where people are signing up legal documents of non-disclosure. Hopefully then you start to receive some offers and enter into a negotiation period, at which time you want to give some thought to some of the specific terms and conditions that are important to you outside of price. The vendor also needs to be relatively mindful and can be advised as to what the likely basic purchaser terms and conditions will be, and perhaps rather than arguing the toss on some of those, just simply concede those and even build them into the original contract, such that some goodwill is established between the parties. The purchaser will then go through the due diligence process, and ultimately you've got settlement, and after settlement most likely a period of time where the vendor is on a golden handcuff.
And as Paul said, the settlement period could extend, 12 months, 24 months down the track. It could be part of the consideration will be on a deferred settlement basis.
Yeah, or earn-outs. Oftentimes, if the practice is on the verge of significant growth, the vendor might want to partake in some of that growth, so might want to share in some of the profits above a certain figure, and that might take a couple of years to flow through. I spoke earlier about vendor due diligence, why you would do it. I think it's really important that the vendor appears to understand their business clearly. By doing a vendor due diligence, you'll have essentially asked yourself the majority of the questions that the purchaser will have already asked, and you'll have the information available to respond to those queries, and it just appears to be a cleaner purchase and a lower risk purchase to a purchaser, and as a result, ultimately with lower risk, the vendor hopefully will get a higher price. When would you do it? I would have thought that you probably need to be giving some thought to this a few years out from an anticipated sale, such that you're able to provide 3 years worth of clean data, so that any trend analysis and those sorts of processes that a purchaser might decide to apply are able to be given to clean data, again without having to make assumptions and that sort of thing. How would you do it? I mean, you could either obviously do it yourselves, accountants sort of know these things, or you may outsource it to another firm who do a lot of due diligence work in any event to help you shape your information prior to a sale. I think the vendor due diligence will also highlight areas that the practice can significantly improve on, and the longer out from a sale date that you can do that gives you more opportunity to actually facilitate changes that enhance the quality of the business and again ultimately the sale price. Spoke earlier about data collection and presentation. That really flows on from doing a vendor due diligence and making sure that you are collecting the appropriate data and able to present it in a manner that's user-friendly for the purchaser. Really, you want to provide information you would want if you were going to make the purchase. So what I think being frank about less profitable aspects of the business is quite okay. You can't present a business in a completely strong case basis. I think you've really got to show where it's strong, where it's weak. Those weaknesses are generally opportunities anyway.
Yeah, I was just going to say the weaknesses are often that could be an opportunity for growth in some particular area. As Paul said, the accuracy is critical. That the last thing you want to do is after the transaction's gone through is then being accused of any sort of misrepresentation or anything like that. So I think it's important to as I said, always keep a commercial sort of hat on in terms of and being realistic and realising that maybe there are a few areas of your practice that aren't as good as they can be, but that's hopefully if you've done your due diligence 3 years prior, you've had a chance to work on some of those areas.
Plus, there are also often opportunities for a purchaser that they'll see that there are opportunities that they'll be able to work on. I think in the information memorandum it's useful giving some history on the practice, and as I mentioned before, a bit of a SWOT analysis where the practice is strong, its weaknesses obviously, its opportunities and its threats. The key areas I think that in a preliminary sense a purchaser is keen on is obviously the revenue. That tells the purchaser a lot about the nature of the practice, what its service lines are, what the size of the clients are, those sorts of things. following on from the revenue, obviously, an analysis of WIP and debtors is also relevant, because that will be telling the purchaser the extent to which they need to invest in the lock-up of the practice.
And that's the same things the banks are obviously interested in, and as I mentioned earlier, the write-offs is something else they're interested in, including the bad debt. So it's all very well to have the debtors, but if you've got a history of having to discount effectively to your clients, that's obviously an issue.
So again, with the data collection and presentation, as Peter mentioned, the information that the banks want, but certainly is very critical to a purchaser, is the listing of the top 20 clients. That gives the purchaser an understanding of the extent of concentration of the practice in large clients. Obviously, having one or two dominating clients presents some risk, or a higher level of risk to the revenue than a more even spread of fees across a couple of hundred clients. Understanding if it's a tax and biz services practice, the lodgement types and numbers is important. And I think, to me, one of the critical areas in terms of risk of the practice is the feeder section across various fee bands and services. So, for example, a lot of small business fees in between $5,000 and $15,000 is likely to present a sweet spot of profitability and risk, compared to having 4 or 5 very significant groups, say $100,000 in fees, and then a whole lot of smaller clients of under $1,000, where the profitability of those fees is much lower. Again, also fee dissections across services. The broader the service offering, the more likely that's a lower risk business, and therefore presents as an opportunity to buy a very secure revenue stream for which a purchaser is likely to provide a higher price or a higher offer than one where they might just be specifically provided in a niche service line. An understanding, which would go in the information memorandum, of the typical fees for your various services gives the clients or gives a client profile to the purchaser that allows them to understand the practice they're buying. As Peter said earlier, with the bank, also appropriate for a purchaser, is the key staffing, charge rates and salaries. This allows them to understand where the risks of loss of key staff may lie, and the potential risk of leakage of clients that might follow. Obviously, people want to know details of the plant and equipment, computer hardware and software. I mean, that when they're asking that sort of information, we're normally a fair way down the due diligence path, and probably fairly close to a settlement of the transaction.
And the charge rates and salaries can often be, somewhat of an indicator in terms of how the two. If you're looking to do a merger, for example, if you've got a large disparity in charge rates and salaries, that can become a whole can of worms down the track. It's just something to be aware of. One of the other issues to look at if you're looking at buying or selling.
Yeah, and I mean that would go to Peter, to if you're buying a block of fees, even a small block of fees of $300,000. If it's being done at average charge-out rates of $100 an hour, and you who are buying its average charge-out rates $150, it's going to be very hard to get profitability out of those fees on your existing infrastructure. The other point there, all data collection and presentation normally occurs at the vendor's premises. That's mainly from a security of data point of view. this process of actually gathering the data together, notwithstanding the energies that may have been applied over the previous 3 years, normally takes at least 30 hours to put it in a format that's appropriate for a purchaser. As I mentioned earlier, you need to be due diligence ready, and the vendor should also be contemplating or have obtained some advice on the tax implications of the sale, because there may be a way to structure the sale in a way, particularly having regard to small business CGT concessions, to effectively end up with more cash by accepting a lower offer, or structuring the post-settlement arrangements in terms of the golden handcuff and consulting fees and those sorts of things that may be able to be done in a manner that advantages both parties. The purchaser, as mentioned earlier, they must be ready with their plan. The vendor in some ways should check and be comfortable that the purchaser is ready with the plan. Their greatest grief will be a disorganised purchaser who causes significant damage to the business after they take over the business and are either unable to settle the balance of the transaction, or indeed and alternatively consider the cause of their loss not to be their own ineptitude, but rather caused by the vendor, either not acting appropriately after the sale, or indeed by being misleading and deceptive prior to the sale. So the purchaser needs to be very clear what the benefits from the transaction are, and make sure they're real and can manage the process to ensure it happens. So particularly if they're buying a block of fees, the synergies that they consider in their minds are achievable really need to be broken down in a numeric sense by doing some proper modelling of how this might be able to be achieved. So somebody suggesting that they might buy $400,000 worth of fees and can do it with the staff that they've currently got, that doesn't seem like a genuinely believable scenario, because it either means that they're carrying too much staff currently, or in the alternative, they need to work their existing staff through the night to achieve that goal. They should never think it's easy, and they should plan for the transition. The personalities involved with the vendor in particular, the vendor's relationship with clients and staff, that subtlety of transition needs to be properly planned by the purchaser with the vendor, as I say, for both parties' long-term benefit. Obviously, the purchaser needs to be ready with the finance and the appropriate structure in which the purchase is going to occur. So just some comments on the current market, and we've formed these views based on valuations and due diligence inquiries and pre-lend inquiries that we've been involved in talking to other accountants and VinLink members, and also financiers. So they're a general view on the market as we currently see it. Certainly it would be fair to say that it's a vendor's market, and there's relatively strong prices out there, particularly for good fees and practices. Top areas at this stage appear to be primarily the CBD and near CBD. Certainly some suburban areas and some regional areas, but more emphasis mainly on the CBD and near CBD. The desirable size seems to be in the 1 to 2 partner level, 300,000 in fees to 1.5 million. There's a strong movement of small practices back to self-managed super funds, and audits, small audits, particularly of self-managed super funds. The financial planning really depends on the purchaser. The recent changes in or mooted changes in the financial planning industry throwing a little bit of cold water on the desire to enter into financial planning practices, or indeed pay significant sums for financial planning practices, and I guess that anxiety will disappear over time as some clarity comes through from the government.
And I think fin planning, if the purchaser's not already in fin planning, they're obviously going to have more of an issue, I suppose, because you can't really be half in it. I think if you're going to decide to go with a fin planning practice attached to your accountancy practice, it's got to be a full commitment to having almost a separate dedicated division, staff, etc.
Yeah, and then the other issue that I'm aware of from some brokers, or not brokers, but some sellers of practices, there seems to be a number of buyers out there who are looking to amalgamate small blocks of fees and effectively outsource those fees overseas, where the cost of servicing the compliance work is significantly less than in Australia. So there seems to be some pent-up demand there, and people being very aggressive in that marketplace. Whether that ultimately holds in the long term, I guess, won't be known for some time. So fees per partner in the medium-sized firms, so 2 to 3 partner firms, are averaging over $1 million, slightly higher in the city, about 15% higher, but you'd probably expect that given the level of rates and the rates of leasing and costs of doing business in the city. The profitability, curiously, is higher in the city, which you might expect, but it is also higher in the country than it is in the suburbs, based upon what we've seen. The lock-up in the suburbs is best, being less than 100 days, and by lock-up I'm talking about the investment in recoverable work in progress and debtors, and it's worse in the city, and the country area seems to be somewhere in between. So the city's about 120 days, it would appear, the suburbs 100, and the country, as I say, somewhere in between. It might also have to do with the nature of the clients. The suburbs probably do a greater proportion of individual returns, many of which have structures in place where they're paid almost immediately on completion of the work. The city firms probably tend to have more businesses who treat them like a source of interest-free finance. Also, probably unexpectedly, the write-offs in the city are higher and lower in the suburbs. Again, the country, for whatever reason, appears to be somewhere in between. The recovery rates, that is the actual recovered charge rate, not the advertised charge rate, is highest in the city, then the suburbs, and then the country, as are the staff costs. So there's a natural drift which seems to have been in place for forever of staff costs being higher in the CBD and near CBD areas. Growth overall has been relatively modest, but there has been growth over the last couple of years, but not much greater than 5% on average. So after inflation, that's a real growth rate of only 2%, with the suburbs only being marginally above inflation.
And I think there has been quite a lot of practices with no growth or slightly negative growth. In fact, that's really dragging that average down a bit.
Down a bit, yeah. So it's a relatively flat market, but you would think by the buying demand that there's some expectation of some future growth in fees or future growth in profitability. Having said that, the prices being paid aren't silly prices, and the valuations seem to be still relatively consistent over the last 4 or 5 years. Sellers of fees less than $1 million, really people are still trying to, they're certainly talking and trying to sell in cents per dollar for goodwill, and then on top of that you pay for plant and equipment and WIP, etc. We think that's appropriate where a small fee base is being merged, because the marginal profit that will be extracted from those fees is normally a lot higher than if those fees were burdened with a full allocation of overheads. So that really maximises the value beyond its economic worth as a standalone business. So you need to be very careful about that if you're buying $300,000 in fees, but you intend to retain the overhead structure of the vendor. That's quite a different price to one that is justified by somebody who's going to take $300,000 worth of fees and add it to an infrastructure that already exists, where they might have a fee base of $700,000 and they simply need to put 1 or 2 employees on to service that fee base. So be very, very careful there. We always like to check back in any event to EBIT, which of course over the $1 million fee mark seems to be what is understood by both sellers and purchasers as the appropriate approach.
So those practices less than $1 million, you know, if you've got someone in their late 20s looking to go out on their own and buying $300,000 in fees, by the time you factor in a salary and a return on the working capital, often, you know, the EBIT's minimal and the return on capital is non-existent. But I think, yeah, the rationale of those purchases is that the alternative is you go out on your own and try and build up a practice, and you spend, you know, 3 or 5 years of hurt with, you know, minimal cash flow and barely making ends meet. So they're prepared to pay a bit of a premium just to get that sort of, you know, a base critical mass, if you like. So that's why it's probably not a totally rational economic decision, but that's why people are prepared to pay what we'd say is really overs in terms of an investment decision, and pay a similar price to what, as Paul was describing, someone with a larger practice is just going to tack the fees on and service them with their existing, you know, from their existing premises and with their existing staff.
Yeah, and in that instance, a bank would normally ask a firm like ourselves to test the value of the practice, the new practice, after the purchase of those 300 in fees. So not value the 300 in fees, but value the existing practice of the purchaser with the 300,000 in fees added in, and consider the reasonableness of the assumptions of the purchaser in terms of how that 300,000 in fees would be serviced in terms of employee numbers, whether they need more space, those sorts of things.
But the bank wants value based on an earnings-based methodology. It doesn't want a cents in the dollar basis. So it wants to know, because that obviously supports the serviceability of the debt as well. So those, you know, people, as I said, you know, in their late 20s who are looking to go out on their own and buy a $300,000 bundle of fees might struggle to some extent to get financing for it. They'll need some other form of security.
So the best price, how does the vendor get the best price? Well, it's clearly dependent on numerous factors. The transferability of those fees is very important. Profitability is obviously very important. There is a risk if a practice is actually too profitable by industry standards. And the reason I say that is there might be something specific to the vendor that allows high profits that may not be transferable to the purchaser. So in fact there could be some discontent in the fee base about the level of fees. Personal goodwill, that's a real risk to a purchaser. Obviously there will be instances where the best price is achieved through a merger or and we discussed buying a block of fees and adding it to an existing overhead, or a merger or gradual buyout may in some instances maximise the value. So that's a consideration for the vendor in the period leading up to the sale of the business. Marketing the business, you then need to decide how you're going to promote the sale, through the press, through direct contact through colleagues, websites, professional journals, or brokers. The purchaser, of course, needs to consider themselves through which channel they're going to seek out a business or a book of fees for purchase. If you are going to use a broker, make sure you use one that's reputable. They generally act for the vendor. Make sure you've got a written agreement with them. They really need to be confidential and professional, and they need to understand the business so that they're not giving mixed messages to what you might be giving to the purchaser. And you need a broker who can walk you through the advantages of different strategies, whether you're using an exclusive or open marketing campaign. In the alternative of using a broker, you can just use an advocate. That's a role that we sometimes fulfil, where that advocate understands your business but allows the purchaser to express some reservations or concerns that they might not otherwise want to raise with the vendor directly, for fear of poisoning the relationship, which is of course important for the business going forward.
We've also sort of done that advocate sort of or middleman thing where there's an internal promotion of someone in the current staff, just to keep someone independent in the middle of it all, so that everything's kept at arm's length.
Obviously, once we've marketed the business and we've got a range of potential buyers, we want to enter into a confidential agreement with them, and obviously that confidentiality agreement needs to be executed prior to the provision of any data or a first meeting. Normally they're prepared by a lawyer and should cover anyone that will have access to your information. With inquiries, you want to work out a strategy as to how you're going to deal with those inquiries early on in the piece, and be consistent so that the information flow is the same for each party. Those inquiries should also be through the one person, whether it's yourself as the vendor or the known third party. If you're going to use a third party, try to use somebody that knows the language and can speak with the purchaser on their terms. You simply don't want misinformation coming from a party who doesn't understand the business that you're trying to sell, or doesn't understand accounting businesses generally. Now we're getting to the pointy end of the transaction. You want to have your response time fairly slick so you keep the purchaser moving on. You don't want them going stale. You want to limit the number of genuine purchasers, prospective purchasers, to a manageable number. Try to identify the best fit for your practice. Again, the purchaser who's going to do best with your practice is the person that will reduce any problems, or reduce as far as possible problems afterwards, and because it will be the most appealing attraction for the vendor, it's also likely to be the most attractive for the purchaser, and accordingly you're likely to get your best overall offer. You want to hold on to your non-negotiable points. If there are many interested parties, obviously you might have to toss some of those away if you're limited to only one or two. I would limit exclusive due diligence periods. Oftentimes a purchaser wants exclusive due diligence and they take forever, and while that's happening, other potential purchasers are going cold. As I said earlier, the prospect's suitability normally results in the highest value. Successful transaction will occur if the transition occurs smoothly. If somebody's got an earn-out, they'll get their best earn-out value if they work well with the purchaser and the purchaser fits the culture of the existing practice. Obviously reduces risk of post-transaction litigation. Let's hope that the prospective purchaser services clients in a similar manner and has a similar culture to staff. That way you'll have the most seamless transition you possibly can. That person needs to be your highest priority in terms of trying to settle the matter. So the way to do that is to meet the key principles. Meet with each party within the same parameters, same length of meeting, same location, same agenda, and as close to each other as possible, so you're able to make comparisons between the key individuals of the prospective purchasers. Try to get value from the meeting. You will reflect on your business as much as they will reflect their suitability for your clients.
And I think most people out there still care for their clients, and so they obviously want whoever's taking over their practice to have that same sort of point of view. So that's something else to keep in mind. When Paul says, someone who runs the practice similar to you is probably going to look after the clients as well.
Yeah, so once you've been through that first meeting process, you obviously want to then reduce your prospect numbers. Try to proceed to a second meeting with this reduced group of prospects. Again, keep it consistent with how you're dealing with everybody, and keep the process moving. Once you've been through that process, then you want to look at structuring the offer. Normally that's driven by the vendor. Hopefully the vendor, after getting some realistic advice, is realistic themselves, is knowledgeable about what's happening in the market. I think it's useful because it's accountants talking to accountants to detail how you arrived at your value. That tends to limit the areas of possible dispute and negotiation, and demonstrates to the purchaser that you didn't just pull a number out of the air, that it's a considered valuation. Keep everyone, all the purchasers, prospective purchasers, aware of your key terms early, and respond to their likely requirements. For example, golden handcuffs. So a vendor might volunteer that if they require them to hang around, that they're prepared to do so for a period of time. Finally, set an acceptance date. Enter into negotiations only with genuine prospects. Try to clarify any unclear aspects of the offer or counter offer, preferably orally, so that people understand that the negotiations being conducted in good faith. The difficulty with lawyers is that the negotiation tends to take on a harder edge than what the vendor and the purchaser actually intend. certainly know early on what terms are negotiable and not negotiable. Then we get down to the process of finalising the negotiations with one party ahead of the other, whether you use term sheets, heads of agreement, or go straight to contract. I think generally will depend on the size of the deal. The vendor normally prepares the initial contract, and hopefully they'll have a sensible lawyer that won't attempt to over-engineer the contract process. Ensure that your non-negotiable terms and conditions are in there, and try to set a time frame through which the contract is transitioning from lawyer to lawyer, such that the document's actually signed within an agreed period of time. So things that are in the offer, normally they include goodwill, plant, equipment, WIP. Things like debtors and creditors existing at close of business or change of business are normally left with the vendor to recover and pay out, although there's often arrangements where the purchaser will collect the debtors on behalf of the vendor, just because the clients are used to paying in a certain way. Normally the purchaser will assume employee entitlements. Need to be careful of the tax implications on that, and that normally reduces the settlement amount. You've got normally transition issues with vendors, employees, how you notify the clients, those sorts of things that need to be agreed between the vendor and the purchaser. But normally most of those issues are at the discretion of the purchaser. The offers normally have clawbacks for under delivery of revenue. Will normally deal with payment terms, so there can be staged payments, restraints of trade on the vendor, and how the transaction is to be funded. In addition, premises is normally quite an issue, so there might need to be an assignment of a lease, or in some practices the vendor is actually the owner of the premises, so a new lease might need to be put in place. And as I mentioned earlier, the creditors and the debtors, who's collecting on behalf of the vendor and who's paying those creditors is normally a side agreement to the normal contract, and then ultimately a settlement date. So timing and announcement, this has to do with how you make the public generally aware, and specifically the key areas that you need to be very careful about, and which involvement of the vendor and purchaser both are important, are the clients and the staff. And the key issue there is to try to keep those announcements positive, which invariably that is the intention of all parties. So as we mentioned early on in the piece, just because you've settled the transaction doesn't mean it's over for the vendor, and often misunderstandings present themselves in the very early days of the new regime. So the vendor in particular needs to avoid mistrust and anxiety, and needs to work hard at resolving matters so they don't end up in court. Both parties need to proactively and positively communicate and work together. Commence the meet and greet process, particularly with the significant clients, and also discussions with key employees. The vendor needs to accept that the purchaser is now in control. The purchaser needs to now start running the business. The vendor needs to understand that the purchaser might have different views on how things should operate, and in which case should cede to the decisions of the purchaser. So in doing so, really the vendor needs to step back, but be supportive of the purchaser. and both parties need to actively work at transitioning the key relationships. So in conclusion, I think it's fair to say that particularly in the information memorandum and due diligence process or data review process, detail is critical. Detail without over-engineering and creating data and documents that can't be traced back to legitimate sources. Everybody needs to be decisive and keep the process moving, in particular the vendor. Both parties need to be informed and realistic about market conditions. If both parties are, the variance in value is unlikely to be significant. Be open and honest in communication. The vendor shouldn't oversell. I think clearly don't let the lawyers fight the small matters. Oftentimes lawyers will bog down the finalisation process. The individuals will think that it's the other individual slowing the process down and get frustrated and perhaps start holding some ill feeling towards the other party. The lawyers really need to deal with the big issues and let the small issues flow. And as we've emphasised the whole way along, the best way to get the best price and the best transition so there's the least amount of difficulties after transition is to get the best cultural fit.
Yeah, I think that assists with, as I said, the mental side of things as well as moving on. If you've got someone else who's taking over your practice that will look after your clients and works in a similar way to you, and then hopefully that any deferred payment terms and the price will hold and you'll get your money and with the least amount of hassle.
So that there's a lot of content there today. We appreciate you tuning in. If anybody would like to get some more detail on the webinar today or a copy of our slides or whatever the case may be, if they'd like to give Peter or I a call. Otherwise, we wish you a good day.